Welcome back to Retail Weekend Wrap Up. I'm Ray Kang, and today is the wrap up for the week of March 16th, 2026. This week, we're focusing on a couple of things, putting them side by side. The first is the big macro story. The Federal Reserve met this week and held rates right where they've been, and the market sold off anyway. Because the backdrop has quietly shifted underneath us, I want to walk you through exactly what this means for your tenants and your retail real estate. The second story, out of the Wall Street Journal this week, sourced from CoStar data that frankly caught my attention for the first time in recorded retail history. Service tenants, think of gyms, spas, fitness studios, personal care, leased more space in 2025 than traditional goods space retailers, more square footage for the first time ever. Together, these two stories again are pointing in the same direction. Consumer is under pressure, and the physical retail space that survives is the one that gives people something they can't get on Amazon. So let's get into it. Wednesday, the Federal Reserve did exactly what everybody expected. They held the federal funds rate where it's been since December, a range of 3.5 to 3.75%, second consecutive meeting with no change. And yet the Dow closed down nearly 770 points to the day. The S&P fell, the Nasdaq fell. When the market sells off on exactly the news it expected, that tells you something. The anxiety isn't about what the Fed did, it's about what the Fed can't do. Here's what the dot plot showed. The median still projects one rate cut this year, but 7 of the 19 FOMC members now expect 0 cuts in 2026. The committee is splitting and the hawks are gaining. They also raised their GDP growth forecast for this year up to 2.4%. And they raised their inflation forecast, core PCE, up to 2.7% for 2026. The message, the economy is holding, but inflation is being revised higher. That's not the environment where you cut rates. So here's the context the Fed is operating in, and the context your tenants, customers are operating in too. On February 28th, the United States and Israel launched joint airstrikes on Iran. The Strait of Hormuz, the world's most critical oil checkpoint, has been severely disrupted. Nearly 20 million barrels per day of crude and product exports were affected. Brent crude oil spiked towards $120 a barrel at the peak. As of the EIA's March 10th report, it had settled around $94 a barrel, still up about 50% from the start of the year. The EIA projects oil will stay above $95 per barrel for the next 2 months before easing. Moody's chief economist Mark Zandi estimated gas could approach $4 a gallon in the near term. Gregory Dayco at EY Parthenon estimated the energy shock could push March monthly inflation to near 1%, the highest single-month increase in 4 years. JP Morgan sees annual inflation possibly heading to 3% or higher. The average American household spends about $2,500 a year at the gas pump, roughly $50 a week. When that number jumps, lower-income households feel it immediately this week in your parking lot. The 10-year Treasury yield climbed back above 4.2% this week. The 30-year fixed mortgage rate is sitting around 6.29 to 6.33%, up from around 6.09% just a month ago. The energy-driven inflation fear is the culprit. Higher inflation expectations push bond yields up. Higher yields push mortgage rates up. Higher mortgage rates push cap rates up. Higher cap rates push property values down, all else being equal. JP Morgan doesn't expect any cuts in 2026 at all. The Mortgage Bankers Association is projecting the 30-year rate between 6 and 6.5% through the rest of the year. The easing cycle that retail property owners were hoping for that could lower their cost of capital, well, that's pushed out further again. So the rate environment you've been waiting on is getting murkier this week, not clearer. If you're holding a property with a near-term loan maturity or a refinance event in the next 12 to 18 months, this week's Fed meeting was not good news. The window for rate relief is getting narrower and the bar for cuts is getting higher. This is not a panic moment, but it's a strategic planning moment. The Wall Street Journal reported this week, citing data from CoStar, that in 2025, for the first time in recorded history, service-based tenants leased more total retail square footage in the United States than goods-based retailers. Split was narrow, 50.4% services, 49.6% goods. But the crossover is real and it's historic. 15 years ago, service tenants were only about 40% of retail leasing. Think about that trajectory. CoStar's national director of U.S. retail analytics told the Journal, quote, "Consumer dollars remain firmly pointed at services. There's nothing to suggest that's going to be shifting anytime soon." So when we say service tenants, we're talking about gyms and fitness studios, spas, nail salons, hair salons, cryotherapy, IV drip bars, pickleball facilities, personal training studios, med spas, tax prep offices, urgent care, dental, vision, veterinary, businesses that deliver an experience in person that cannot be replicated online. You can't get a haircut shipped to you. You can't do yoga in a shopping cart. You can't get Botox on Prime. The CoStar data showed a specific call out around fitness. Expansion activity increased meaningfully in 2025. Fitness tenants have proven particularly effective at absorbing second-generation retail space, including former big box and junior anchor locations. They drive consistent foot traffic, longer operating hours, and daily visit patterns that benefit neighboring tenants. Entertainment retail also grew its share. Immersive experiences, recreation concepts, and social activity spaces. The national retail vacancy rate is still sitting at 4.4%, near record lows. So how is that possible? Because service tenants are absorbing the space. Every time a goods-based retailer vacates, a fitness studio or a spa or a medical tenant is waiting in line. They are holding the entire retail real estate market up. One important nuance: restaurant leasing actually declined as a share of overall service leasing, falling to its lowest post-pandemic level at just 16.8%, even as consumers spent more than ever on food away from home. Restaurant operators are being much more selective about where they sign leases. The days of every QSR and fast casual brand expanding everywhere are over. So if you own a strip center right now, here's what this data is telling you. One, your vacant space is more valuable than you think. If you're in a submarket with the right demographics, service tenants are not just searching for cheap rent, they're hunting for the right location, right co-tenancy, right traffic pattern, and they are actively expanding. Number two, the tenant mix in your center matters more than ever. A center full of service tenants, nail salon, gym, urgent care, dental, is a center that e-commerce literally can't touch. That is the most defensible thing you can own in retail right now. And number three, if you have a tenant renewal coming up for a goods-based retailer who is struggling, this data should inform your negotiating position. You may have more leasing demand in the service category than you realize. Don't automatically renew below market because you're afraid of vacancy. Number four, this is a repositioning opportunity. Centers that were 70% goods-based 5 years ago can be repositioned. The leasing demand is there, and the consumer spending behavior is pointing in a clear direction. The strip centers that win in the next decade are not the ones with the best collection of retailers selling things. They are the ones with the best collection of businesses delivering experiences and services that people have to show up for in person. That shift is not coming. It's happened already, and all of this data is just confirming it more for the first time statistically. So the Fed held rates this week. The dot plot shows one possible cut, but the energy shock from the Iran conflict has raised inflation expectations, pushed Treasury yields higher, and put the Fed in a very difficult position. Lower income consumers are getting hit at the pump right now. That matters for the tenants in your center who serve those customers. At the same time, the physical retail market, particularly for service-oriented space, is as healthy as it's been in a long time. Vacancy near record lows, service tenants leading leasing for the first time in history, gyms, spas, fitness, personal care, medical, all of them actively expanding and absorbing space. The owners and investors who understand both of these forces at the same time is the investor who makes better decisions. The rate environment is telling you, be thoughtful about your hold period and your capital stack. The tenant demand data is telling you the right service-oriented strip center is as defensible as it's ever been. Thanks for joining me. If you found this useful, please subscribe to the channel. You can also find my newsletter, stripcenteriq.com. And if you own or are considering a retail center in any of our markets that we work and want to talk through what any of this data means for your specific property, feel free to reach out. I'm Ray Kang. Have a great weekend.